What exactly is value investing? Value investing is a type of investing that focuses on stocks that are undervalued by investors and the market as a whole. Stocks that value investors seek generally appear inexpensive in comparison to their underlying sales and profitability. Investors that employ the value investing method anticipate that the stock price will grow as more people recognize the genuine inherent worth of the company's core business. The bigger the gap between intrinsic value and current stock price, the larger the margin of safety for value investors seeking investment possibilities. Because not every value stock will successfully turn its business around, that margin of safety is critical for value investors to limit their losses when they are wrong about a company. What characteristics distinguish an excellent value stock? A value stock is distinguished by its cheap valuation in comparison to the value of its assets or important financial measures, such as revenue, profits, or cash flow. However, the best value stocks have additional attractive characteristics that make them appealing to value investors. Businesses that have a long track record of success, profitability that is consistent, stable revenue streams with no significant increase but also no significant sales decreases. Dividend payments, albeit dividend payments are not required to qualify as a value stock. However, it is critical to recognize that a company with all of these characteristics is not necessarily a great value stock. When a stock appears to be a good value for investors, it may actually be a value trap. Even when their stocks appear to be appealing, value traps might continue to experience share price decreases. Why should you buy value stocks? Everyone enjoys a good deal, and because value investing targets equities that are selling at a discount to their underlying worth, the investment approach is appealing to individuals who enjoy getting a good deal. All it takes for a value stock to earn money is for enough other investors to see that there is a mismatch between the stock's present price and its true value. When this occurs, the share price should rise to reflect the increased intrinsic worth. Those who purchased at a discount will then profit. Furthermore, many investors prefer the margin of safety provided by a stock purchased for less than its intrinsic value. There is no assurance that the stock price will not fall further, but it makes subsequent share price reductions less likely and less dramatic. A solid value stock can give both protection against losing money and the possibility to cash in once the stock market realizes the stock's actual worth for people who consider themselves defensive investors with a low risk tolerance. Patience is required when investing in value stocks, since it typically takes a long time for a value stock to be repriced at a more appropriate and higher level. However, for those willing to wait, the rewards can be quite substantial. How to identify value stocks? Value investing necessitates extensive investigation. You'll need to complete your research by examining a large number of out-of-favor companies in order to calculate a company's intrinsic worth and compare it to its current stock price. You may have to look at hundreds of firms before finding a single one that is a real bargain stock. Many would-be value investors are put off by this, but there are several strategies you may use to uncover solid value stocks. By properly knowing the various methods for valuing a firm and assessing its commercial prospects, you may swiftly eliminate ineffective companies and focus on your finest options. Avoiding value traps. A value trap is a stock that appears to be inexpensive but is not. A few of scenarios frequently cause value traps that value investors should be aware of. Earnings in cyclical industries such as manufacturing and construction can grow significantly during boom periods, only to evaporate when business conditions drop. When investors expect a firm to go collapse, its value will appear relatively cheap in comparison to previous earnings, but much less so after earnings decline during the slower stage of the economic cycle. Stocks that focus on intellectual property are prone to becoming value traps. For example, if a pharma business has a popular therapy but is about to lose patent protection for it, a large portion of its income might vanish suddenly. The same is true for a tech business that is the first to market in a new field but lacks the capacity to compete. To avoid value traps, remember that when evaluating a stock, the future of a firm is more essential than its history. Focusing on a company's potential for future sales and profits growth will increase your chances of finding real value stocks. Is value investing appropriate for you? If your major investment aim is to reduce your risk of irreversible losses while raising your chances of producing positive returns, you are most likely a value investor at heart. Those who prefer to follow the market's hottest businesses, on the other hand, generally find value investing to be simply dull, as growth potential for value companies are often lukewarm at best. Value investors must also be resilient. During a bull market, the value-finding process excludes much more stocks than it uncovers, and it may be a very difficult method to invest. Many of the companies you remove from your purchase list throughout your search will continue to rise in value during bull markets, despite the fact that you thought they were too pricey to begin with. However, when the bull market ends, the margin of safety provided by value stocks can make it much easier to ride out a downturn. Value versus growth investing. If value investing does not fit your investment style, you may want to pursue growth investing. Growth investing focuses on a company's chances of seeing its sales and net income climb rapidly over time, with a focus on the market's fastest-growing firms. Growth investors are less concerned with intrinsic value than value investors are, instead relying on spectacular corporate growth to justify the higher values investors must pay to purchase shares. How did value investing begin? Over time, value investing has evolved. Its origins may be traced back to the Great Depression and its aftermath, when the strategy's only concentration was on purchasing firms whose assets were worth more than the shares sold for. This was partly due to the fact that many firms were going out of business at the time, and chances to acquire stocks for less than the value of assets had immediate consequences when a company dissolved. However, value investing has evolved into a more fundamental examination of a company's cash flows and earnings. To determine if a stock is substantially undervalued, value investors consider a company's competitive advantages. What are the names of the two most well-known value investors? Benjamin Graham is widely recognized as the father of value investing. Graham's Security Analysis, published in 1934, and The Intelligent Investor, published in 1949, established the fundamentals of value investing, including the notion of intrinsic value and the need of having a margin of safety. Aside from those two invaluable books, Graham's most lasting contribution to value investing was his role in laying the groundwork for legendary investor Warren Buffett. Buffett studied under Graham at Columbia University and briefly worked for Graham's business. Buffett, as CEO of Berkshire Hathaway, is possibly the most well-known value investor. Buffett began value investing in his early 20s and utilized the method to achieve massive returns for investors in the 1960s before taking over Berkshire Hathaway in the 1970s. However, the influence of Charlie Munger, Berkshire's vice chairman and Buffett's long-term investing partner, as well as Buffett's evolution as an investor, has influenced Buffett's strategy. Instead of focusing just on buying inexpensive assets, Buffett has altered his focus to acquiring high-quality enterprises at affordable prices. This renowned Buffett remark best shows why his value philosophy has evolved over time. Better to buy a wonderful business at a fair price than a fair business at a wonderful price. Allow value investing to help you. The first crucial thing to realize is that value investing necessitates a long-term outlook. According to economist John Maynard Keynes, the market can remain irrational longer than you can remain solvent. The lesson is that while time might be fortuitous and an investment can pay off fast, even a value-focused strategy cannot guarantee quick results. Mr. Market does not always realize quickly that it was incorrect about a stock or undervalued an asset. It takes time to implement value investing ideas, but the time and effort you put in are well worth it. Understanding and using the value investing ideas Graham discussed over 90 years ago, and those Buffett and others have added to and improved upon since, can make you a better investor with a higher chance of selecting terrific stocks.
Thanks for watching. Don't forget to click the like button. Subscribe and click the notification button if you want more daily updates on building wealth, personal finance, and achieving financial independence. And remember, the world is yours.